Last December, a client almost lost his pre-approval because a mortgage rule changed overnight, and that was in 2025. 26 is looking like it could be even worse. Today, I'm breaking down the 5 new 2026 rules that will catch buyers off guard and how to protect yourself so you don't get blindsided at closing. These changes hit your interest rate, loan approval, monthly payment, and even how much house you qualify for. But before we hop into today's lesson, if it's your first time watching, go ahead and hit the subscribe button and also hit the bell to get notified on all the new content we put out every single week. So let's hop in. Rule number 1, stricter debt to income requirements, the silent deal killer. Investors are tightening debt to income overlays, and there are new versions that are coming out of automated underwriting engines, also known as AUS. 2026 buyers are seeing that their approvals could shrink because underwriters are scrutinizing variable income harder than they ever have before. Now, for those that get bonus commissions or self-employed, these type of loans are going to require more documentation for underwriting. The debt to income ratio used to be more flexible, but in 2026, one small extra credit card, it could completely kill your loan approval. So here's what you want to do. First of all, pay down your revolving debt, like your credit card balances, at least 60 to 90 days before you apply for a mortgage. Next thing is document all your income early in the process. You want to get a full pre-approval to ensure that everything is bulletproof and you're not going to have any questions or concerns when it comes time to underwriting. Next is don't open any new accounts or make any large purchases during the pre-approval or home buying process. That could really screw things up. Check with your lender the max debt to income calculation with the different programs available. For example, VA, USDA, FHA, and conventional. They all have different rules and different calculations. All right, so rule number 2 that's changing, insurance premiums. In some areas of the US, we are seeing insurance premiums surge through the roof. What's happening is 2026 has a lot of insurance companies recalculating how much the insurance premium is going to be. The big things they're looking at are how much loss has been incurred in the areas. The ones we're seeing with the biggest changes are areas that have a lot of fire zones, coastal regions, and older homes with older mechanicals or older roofs. Some buyers are seeing their insurance premium jump anywhere from 20 to 40% year over year. So it's a big jump in a short period of time. And what I see happen so often is that people qualify for a home, but then they get denied later in the process because the insurance premium bumps up their payment too high and now they no longer qualify for the mortgage. So what can you do here? Well, first of all, get an insurance quote early in the process. As soon as you go under contract, even beforehand, don't wait until you're going into underwriting to do that. You don't want to be blindsided with a last minute concern. The next thing is avoid older roofs, outdated plumbing, and fire zone areas. If you're buying in these type of areas, you can expect your insurance is going to be a lot higher. And if you're buying properties with those older mechanicals or roofs, then know that you may have some major repairs to be responsible for or have that insurance increase when you go in to buy the property. Run a realistic monthly payment scenario, including the insurance and the property taxes before you go under contract. This is absolutely crucial. Now, the next rule I want to talk about are new appraisal standards. And I think in this case, we're going to see low appraisals or appraisals coming in under the purchase price. That could spike. So in 2026, there's going to be more scrutiny added to appraisals. They're going to be looking more carefully at the condition of homes, accessory dwelling units, if there's been additions, or in investor-heavy neighborhoods for sure. You can expect that appraisals are likely to come in more conservative after several years of increasing home values. So if your appraisal comes in low, your option is either to renegotiate or pay the difference. And most buyers just aren't prepared for this. So what you want to do here is you want to avoid unique properties that may have had garage conversions or extreme cosmetic issues. And use comparables with caution. Ask your lender to do a pre-approval review before you actually go under contract to make sure that you have all questions or concerns handled ahead of time. Next thing is keep cash aside for potential appraisal gaps or renegotiation. So if that appraisal comes in short, you want to have some money available to actually cover that gap in case you can't renegotiate. The next rule to talk to you about is the PMI and FHA MIP calculation. This can really change the payments and create payment shock for first-time buyers. So what you want to do is compare an FHA loan to a conventional loan, specifically the PMI, the mortgage insurance part of it. Because in many cases, PMI is more expensive for a 3 to 5% conventional loan than it would be on an FHA loan unless your credit is really, really strong. And here's why it matters is two buyers with the exact same down payment on the same property might get completely different mortgage payments, and that can come down to the type of loan program they choose and specifically the PMI or MIP calculation of that monthly payment. So here's what you can do to combat this is push your credit score up as high as you can, at least 20 to 40 points before you apply, especially if you're looking to get a conventional mortgage where they really scrutinize your credit score. Another thing to do is compare FHA versus conventional loans side by side. Don't just assume that conventional 3% down is always the cheapest path, because in many cases you'll find, especially if your credit is mid to low tier, that you're gonna actually get a better deal, a lower payment using the FHA program. Rule number 5 that's changing, rate structure now is favoring more towards buying down your rate. So investors in the secondary mortgage market are pricing long-term fixed rates differently than they did before, all based on the economy and what's expected over the next couple years. Now, buy downs are becoming one of the only ways buyers can lower their monthly payment. And in a lot of cases, you can get a seller to pay the buy down for you. Also, lenders are incentivizing certain buy down programs like seller paid 3-2-1 and 2-1 buy downs, which can lower your monthly payment and your mortgage rate for the first 2 to 3 years of owning the home. In 2026, if you don't buy down your rate at all, you might be paying several hundred more dollars per month than the person that did. So here's what to do here. Use part of your home buying and down payment budget to go towards that rate buy down. Negotiate seller concessions specifically to go towards that interest rate buy down. Avoid wasting all your money on putting a bigger down payment, but you want to spread that money out strategically between your down payment, your closing costs, and potential interest rate buy downs. And always compare a permanent interest rate buy down versus a temporary interest rate buy down to see what's going to be best for you. A simple 4-step structure for you to make sure you succeed in 2026. First of all, run your scenario early, not your 2025 numbers, but the current numbers based on current rates, premiums, and the current mortgage guidelines. Next, prepare your credit before you even go to a mortgage lender. Get that credit optimized so you can really get the best deal possible. Payment sensitivity in 2026 is major. Use a strategic cash allocation. So make sure that you've got your money divvied out between down payment, closing costs, rate buy down, and we can't forget those reserves to have money available after closing. Don't house hunt at all until you run your financial scenario with a lender. Most buyers shop first and then calculate later, which is where they get hit with reality sometimes when it's too late. If you're planning on buying a home in 2026, then this could be the optimal scenario for you. I'll run the numbers with the new rules so you don't get trapped by these changes. And next, watch my video. If I had $40,000 saved in 2026, here's exactly what I do. It pairs perfectly with this one.